We're ready to start when you are.
Good morning, everyone. Meeting stakeholder relations.
Yes, Trustee Wabi.
Here.
Trustee Watson.
Yes.
Trustee Evans.
Yes.
Trustee Nikozison.
Yes.
Trustee Wilson.
Yes.
Trustee Fair.
Yes.
All right, everyone's here.
Thank you. Mr. President, you have an
Thank you, Mr. Chairman. The presentations today are in response to the rate recommendation report of the Rate Commission of the Metropolitan St. Louis Sewer District, specifically the proposed wastewater rates. There are two general topics that will be addressed: the debt coverage ratios used by MSD in its financial plan and in their proposal, and whether or not to phase in the increased cost for extra strength surcharge paid for by commercial entities which discharge extra strength waste. As far as the debt service coverage, the Rate Commission voted 11-4 to support the debt coverage ratios used in MSD's proposal. A minority report on page 155 of the rate recommendation report was filed by 4 of the Rate Commission delegates. It advocates for a different debt service coverage ratio that results in future rates different than what was approved by the Rate Commission. For the extra strength surcharge issue, the Rate Commission voted 13-2 to support the immediate charging of this new rate as described in MSD's rate proposal. A minority report on page 157 of the rate recommendation report was filed by 2 of the Rate Commission delegates that advocate for phasing in the increase in this charge. I do want to provide a historical reference to previous Rate Commission reports and the response by MSD. Both the fiscal year 2017 through fiscal year 2020 report and the fiscal year 2021 through 2024 report recommended wastewater rates lower than were provided for in the original MSD rate proposal. In both cases, after reviewing the impacts to our short and long-term financial plans and revenues, MSD accepted the risk of these lower rates. In the current fiscal year 2025 through 2028 report, the Rate Commission agreed that the rates resulting from MSD proposal were appropriate, and in this case did not recommend any adjustments. Speaking today for the first 40 minutes will be representatives from the Missouri Industrial Energy Consumers and the Consumers Council of Missouri. They are in support of the views expressed in the minority reports. Speaking for the last 20 minutes will be MSD Secretary Tim Snoke. Because the Rate Commission has completed their proceedings and submitted their report supporting the MSD rate proposal, Tim Snoke will speak to the information expressed in the final Rate Commission report. And I'm done, Mr. Chairman.
from Missouri Industrial Energy Consumers.
They're not here right now.
Yes.
We should go. We hadn't planned to go first, but we'd be happy to go first while they're getting here. Oh, okay. Great. You ready?
Yes, sir.
Yes.
My name is John Kaufman. I'm an attorney for the Consumers Council of Missouri, and I'm here with Sandy Paget, who is the Executive Director of Consumers Council. We are a nonprofit, nonpartisan organization that represents the interest of consumers, and one of our main areas of focus are utility rates in the state. And I want to be clear, our interest is different than the Missouri Industrial Energy Consumers. On the main issue here today, we are on the same page, and we have that the interest coverage ratio issue is something that affects the entire region. We are not necessarily in favor of their other issue, which relates to the industrial sludge surcharge. But we are together in supporting the minority report on page 155, and that is our ask of you here today. In my 34-year career as a consumer advocate regarding utility rates, I've participated in almost 300 rate cases or rate reviews, both investor-owned utilities and several municipal utilities. And I have never seen a more lopsided recommendation than the majority report that's in front of you today. Not one adjustment is made to the MSD proposal. No adjustment is made for the benefit of consumers. If you follow the majority recommendation of the rate commission body, MSD would get their entire request, plus an extra layer of financing that they have never been allowed in previous MSD cases. This board has never allowed this extra interest coverage calculation in the revenue requirement. Despite some lip service in the minority report, there is nothing. Consumers lose every single issue. I can't tell you how unusual that is. I have never seen that in any rate review before. But luckily, you do have two recommendations in front of you. The minority report on page 155, which recommends that you follow the same practice that you did in the previous MSD rate review 4 years ago, and the review before that, and the review before that. It is a financial policy that has served our region well and has at least provided some mitigation to recognize the impact on consumers. But as an example, let me run down some of the other rate increases that have happened over the last year in our region for the other monopoly services that customers have no choice for taking. Ameren, Missouri requested an 11.6% increase in their electric rates in 2022. And after a thorough review and some settlement and back and forth, the Public Service Commission in Jefferson City ordered a 5.1%. So that was less than half of what they asked for. Spire, Missouri, earlier in 2022, requested a natural gas increase for its base distribution costs, $152 million. They asked for an 11.5% rate increase. The Public Service Commission ultimately ordered that they receive only an 8% increase. And because of the way certain surcharges folded in, it was really only a 4% increase. Missouri American Water Company just recently completed a rate case and full rate review. They had requested a 25% increase in their annual revenue requirement. The ultimate rate impact for customers after a full rate review was in the range of 8 to 11%. So in all three of these other monopoly services that customers in our region have to do, after a thorough review, they received less than half of what was requested. In this particular case, MSD is, if you follow the majority report, will get 100% of every issue. No mitigation, no moderation, no balancing of the interest. I mean, to call this a balanced report, I think takes a lot of nerve. We are asking for the most modest adjustment. We are asking only that you go back to the financing policies, or rather the method of calculating the revenue requirements that you have done in the past, and that has served MSD so well that they have over an A bond rating. By the way, the Missouri Public Service standard that they use for setting rates and for balancing the interests of utility versus the customer is it just and reasonable? So it's a reasonableness. They have a lot of discretion, but it does require, under the law, a balancing of the interests. You have to show that you have considered both sides. I would argue that the MSD board has a legal standard that is even more concerned with the consumer impact and puts even a higher standard on this board to consider the consumer impact. In fact, the words in the charter are that you must consider the financial impact on all classes of ratepayers in determining a fair and reasonable burden. So your decision has to consider the burden on the ratepayer. And I looked through the entire rate review report, all of the evidence in the record, so to speak, and I found almost no evidence of what a 32% rate increase would do to a normal family or to a normal business in our area. Almost all of the information in that report deals with the balance sheet of MSD and its desires for having an extremely high protective financial package and protection against any financial vagary that might even possibly happen. I would again ask you to go to the very concise and well-written minority report on page 155 where Commissioners Goss, Palins, Stein, and Tonjes ask that you go back to the 1.6x debt service coverage impact when calculating the revenue requirements. This will moderate the rate increase somewhat. And let me just read their words. The opinions of the rate consultant regarding an inability to meet bond covenants are entirely conjecture, and as are those of the district concerning what might occur 4 years hence. Further, the comments are not supported by the evidence. It is apparent from the district's evidence and that of our own rate consultant who evaluated the alternative debt service coverage ratio scenarios that all of the formulas keep the debt service ratio at or above 1.6x, which is the coverage that the underwriters require. There is a cost to being overly conservative, and in this case, the cost is being borne by those who are least able to afford it in our population. As such, this overly conservative policy places an unfair burden on certain classes of ratepayers within the district. It could not be more clear that this new policy would add an extra burden on consumers. And is that, I guess you could say, well, this is just a small increase. Why not just have the most protective, highest possible bond rating and highest protection against any potential possible predicted downgrade? Well, that is not necessarily what is in the consumer's interest, and it's not just a matter of timing either. We know that every dollar matters. We know that from a study done on Missouri utility rates by Tufts University that with every dollar increase in rates, there is a corresponding impact on employment. We also know that with every dollar increase that is excessive or unnecessary, there will be more bankruptcies. More people will lose their homes. More people will be unable to pay all the bills that are on their kitchen table every month when they're trying to make ends meet. So that is why we'd ask that there be some give or take, just one issue. Give us just one mitigation for the benefit of consumers, and understand that any alarms that you are told that might happen to increase the borrowing costs are going to be just a small percentage of what the corresponding increase is needed to replace them. It's something on the effect of 5% the size. So rates are being increased by a massive amount in order to protect the possibility that maybe debt borrowing costs in the future might go up a little bit. But those increases will be incremental, and those will be only for prospective borrowing, and it's all speculation. Also, the fact that this is a 4-year plan is more of a burden than what we normally see. These other Public Service Commission monopoly regulation schemes look at 1 year. And once the utility gets an increase, that's what they have to live with until it's not enough, and they come back and ask for another increase. Here, we are looking at a 4-year increase. So this is not just a 7% a year. This is a 32% increase. You would be locking in something over a long period of time, not knowing exactly what happens to the economy. And if there is something unexpected that happens in the economy that affects debt costs, that economic uncertainty will also be happening to homeowners and to businesses in the region. So for these reasons, we would ask that you go back to the same policy that this board adopted in this last rate case, and which has served us well since the consent decree. We are not asking that any project be scrapped or delayed. All of the work that needs to be done or that MSD wants to do can go forward. We're just asking that this extra layer of financing not be added to the burden that ratepayers have to pay. And if you cannot make this even one small adjustment for consumers, I don't know that there's any hope for this process. So that is our plea, and I think that Sandy Paget would also like to address you. Well, so I'll defer to her.
Thank you so much, first of all, for putting this meeting together and allowing us to talk to you one more time. As John mentioned, I am the Executive Director of Consumers Council of Missouri. We represent all consumers in Missouri, but we especially focus on the needs of those who are low and moderate income. And what we're finding, we have a couple of community advisory groups that advise us on our policy recommendations. They're giving us the real life stories of what they're experiencing. And what we're finding is that these rate increases are putting people over the edge. This year, we put together 2 customer assistance meetings, and we're really hopeful that the next time we do this, MSD can be there too. But these are meetings where representatives of Spire and Ameren and the community action agencies are there to process applications. For both of those meetings, the first one, I didn't think we'd have anybody show up because we barely publicized it, standing room only. The second one, same thing. We didn't even publicize that. One person did put it on their Facebook page. We had over 60 people there. You know, these small increases, I think that a lot of us are insulated. I know I am guilty of that too. Right now, my MSD bill is almost $100, and that's high in terms of what it used to be. But, you know, I can pay it. I'm comfortable. I can do it. But for people who are living on the edge, this is really a struggle for them. You know, this extra $10 a month, even an extra $5 a month is something that could be the difference between staying in a house or if you're renting, you're not eligible for the customer assistance programs because you're not paying your bill directly to MSD. You know, instead, your landlord's paying the bill, and so then your rent comes up. And, you know, it's our understanding that evictions are on the rise in the St. Louis area. You know, I think it's particularly harmful when this is wrapped up with the cost of water in St. Louis City. People in St. Louis City, they don't have any way to change their habits to decrease the impact of the rate increase. They're stuck. So, I ask you to take that into account too. Their sewer rates are based a lot on their water rates, and their water rates in the city are based on the number of bathrooms and the number of bedrooms in their house. So, I'm new to this. I'll admit, you know, I've only been doing this for about 1.5 years. But what I've learned is that the best customer assistance program is a reduction in the utility rate or a decision not to raise the rates as high as you had initially planned to. Customer assistance programs are wonderful, and we look forward to working with you to expand yours. But the fact of the matter is that people who are low income don't have the time or energy to apply. You know, when they go to apply for a program and they don't bring all their documents with them and they're rejected for the program, they don't have the time to go back and sit down and collect everything. They just quite frankly give up. So, you know, as John mentioned, what we're asking the trustees to do, quite sincerely, is to adopt the minority report. We think that that's a good compromise in this situation, and we really hope that you'll look closely at it and not approve the rate commission's decision. Thank you very much.
Thank you. The Industrial Energy.
Good morning.
Morning.
I want to thank the Board of Trustees very much for allowing us to present as consumers today. And I also want to thank Brian Holscher and the other members of the MSD executive team that helped us to create this opportunity. We have not appeared before the board in previous rate cases to discuss this because in past rate cases, we've been able to agree with the parties and the rate commission process didn't create any obstacles for us. It worked well. This time is a little bit different. It's not that the rate commission process itself is the problem, but we just disagree with the decision. And we thought it was important enough and had a great enough impact that it was worth bringing to the trustees because ultimately, as a matter of law, the Board of Trustees is assigned and has full authority by the Missouri Constitution to enact rates, not the rate commission, no other party, and the discretion is completely with you all. And I think that the matter that we're bringing before you is truly one of policy. There are technical aspects to it, but it's a very fundamental policy decision about what level of debt service coverage is required in order for MSD to be healthy and strong and have full access to capital, while at the same time making sure that customer rates are affordable and that any rate increases are gradual so that customers have time to adjust, whether business or low income or mid income. I'd like to start out, first of all, by talking about the MIEC, the Missouri Industrial Energy Consumers, and our history of participation before the Rate Commission and before the board. It's very long-standing participation. We have been appearing before MSD for over 20 years. In fact, when I was a young lawyer in the 1990s, there was a lot of controversy about MSD. There was a feeling that MSD was not well managed at the time. There were very large rate hikes at stake, and the stability of the entire sewer system was at issue. We participated in many meetings of the RCGA, of Confluence St. Louis, many meetings with the utility, because the utility is so important to my clients, the large businesses, that we were very active in particular in this process. And as a result of that, the Rate Commission was born. And the Rate Commission was designed to provide an opportunity for people to get technical issues out of the way, to give good advice, create a process so that when the MSD board is finally reviewing a rate increase, there is a very ordered process and lots of information for you to look at. We only bring this to you because it's an unusual situation in that you can look at the record and make two completely different decisions in this case. One is to increase the minimum debt service coverage of MSD, which is a big thing to do. MSD has a history of high bond ratings. Going back to 2013, I looked at all of the Fitch and the Standard & Poor's and Moody's reports and summaries that MSD has on its own website, which is very helpful. And they've all been the second highest possible rating. Very good access to capital, very high ratings. And all of those reports note the rate setting autonomy of MSD, that MSD has great rate setting flexibility. You can come in very quickly compared to other utilities in less than a year and get rate increases done. That you have autonomy. You're not regulated by any outside entity like Ameren or Spire. And so there's a very directness and an ability to be flexible with respect to MSD's rates that the board has. And one of the things that we're very concerned about is if something isn't broken, why fix it? And also there could be very negative consequences if you increase MSD's debt service coverage even more, because it will increase rates by about $20 million a year for the 4-year period. And that's a big impact on all consumers. Also, once that debt service coverage is higher, it's going to be baked into future policy and future cases. But most of all, there's no need. Looking back at the evidence, and I'm sure you have and will continue to do so on this issue, the evidence in this case is not that there's any problem right now or that there's likely to be one. There is some speculation in the testimony of one of the Rate Commission's witnesses, for example, that something could happen in the future that would cause a higher debt service coverage to be needed. That's possible. Anything is possible. And most ratings reports will have sentences like that somewhere to couch their rating, just to make sure they're catching all possibilities. But the truth is that MSD not only has a very high bond rating now, it had a high bond rating 10 years ago under the same policy. And to change that policy when it's been working so well doesn't make sense. I'd like to point out that Fitch just rated MSD on October 11th. And when I checked last night, it looked like that ratings report is not yet on MSD's website, like the other ratings reports. But I want to read to you a very compelling statement in the Fitch report. And keep in mind that this statement by Fitch was actually provided after this rate case was filed. And with Fitch being aware of the issues, very aware of the issues in this case, as you can imagine. And I'll read this to you. Also distribute copies of my presentation and the Fitch report to the board. This is from Fitch, October 11th, 2023. The district's leverage, measured by net adjusted debt to adjusted funds available for debt service, was 5.0 times in fiscal 2022, fiscal year ending June 30th, and is expected to increase over the next 5 years, yet should remain at a level commensurate with the current rating. Substantial capital work is anticipated over this period, dominated by a $900 million project to replace existing incinerators. The addition of this project along with ongoing regulatory work supporting an existing consent decree, could lead leverage to temporarily peak about 7.0 times. But Fitch's expectation is that leverage will decline after this time of peak spending. Should costs remain elevated or additional projects needed, the rating could be pressured. So what Fitch is saying here is that the current minimum debt service coverage is adequate for all needs expected now and in the future. And that's very important because it goes completely contrary to what MSD staff's witnesses put forward in the rate commission case. I'd like to also mention that there is another rate affordability issue that's very concerning only to the large business customers. In particular, my clients are large industrial customers. And it has to do with the extra strength and volumetric surcharges. One of our clients would have almost a 30% increase in the first year of the 4-year rate increase period. And that's very hard for businesses to plan. It's very hard for businesses to absorb costs like that so quickly. And the investments required to do those things take time to ramp up. And so it would make sense, I think, to the extent that any change needs to be made in the wastewater extra strength surcharge, or any change needs to be made in volumetric surcharges, if the commission were to go in that direction, if the board goes in that direction, then they should certainly implement it more gradually. We urge the board to take a look at the minority report. That report is, I think, especially compelling because 3 of the minority dissenters have been on the board, on the MSD rate commission for almost since it was conceived. Jack Stein, Len Tonjes, and Brad Goss. Those 3 gentlemen have been with the rate commission for many, many years, and they've seen this issue over and over again, and yet they feel that the rate commission had it wrong. So I would encourage you to look at the minority report, and that report is going to really lay out a roadmap for you on how you could change this, and the board could adopt a decision that, for the most part, accepts the rate commission's recommendation. But on the minimum debt service coverage issue and on the wastewater rate design issue, adopt the minority report. And I'm happy to answer any questions. Our witness, Mike Gorman, our technical expert, was supposed to be here, but I think he had an emergency. Is it possible to take a short break? I apologize for that, but I've been told he's on his way and will be here any minute.
Know the availability of the total board.
Well, I think an hour was reserved.
Yes, an hour. How extending the hour would.
I see.
The rest of the board.
Yeah, I could speak.
Is it possible for you? Okay, that would be great.
If you could go, maybe we could go, and if he can get here before
Yeah, I'll take my
20 minutes now.
20 minutes now, and then he can speak.
Good.
Okay.
That's good.
Yep,
Thank you.
that's okay. Yeah, I know, it's early. We're gonna
Thank you,
pull up some slides. Okay, can you check me? All right, thank you, trustees. We've talked about some of these issues before, but I'm going to try to address quickly a few things that I heard, and then as we go through this, I've got some comments that I want to make. We heard that I cannot speak to the PSC or how MOAM or Ameren or Spire negotiate their rates. When MSD puts forward a rate proposal, we're not looking at it as a negotiation. We don't have bonuses, we don't have dividends, we don't have stock buybacks. We're a local government entity that is putting forward what we believe is a fair and reasonable proposal. Because it is a 4-year proposal, I think you can always argue that we're trying to be conservative because there is risk over those 4 years. And as a matter of fact, over these last 2 rate proposals, we have not met our revenue target. We've collected significantly less revenue than forecast. As we have had trouble forecasting water conservation as well as the
Keep going, Tim.
pandemic has also reduced volumes. And that was not offset by lower operating costs. Operating costs were also lower, but not by as much as revenue. So it was a net miss. So where we've been able to deliver really is because we've had low inflation, that's reversed, and we've had low interest rates on debt. That environment has also reversed. So I'm going to talk a little bit about that. MSD, just like the interveners and Consumer Council, are all looking at what's best for consumer. To say that there is just one way to deliver that, I think, is incorrect. It's dangerous to say that the rate commission must acquiesce to business interests or any other outside interests in order to be being fair. The rate recommendation balances long-term costs versus a short-term benefit. When we issue debt, it's for 30 years. Usually the SRF is some 20-year debt, but higher debt costs are going to lead to higher rates. So I'm going to go through that. I'm also going to go through how our metrics are not being overly overly conservative, or actually being pretty aggressive. Some of our financial metrics are already pushing toward or into single A category ratings. And the proposal from the interveners would exacerbate that and push us farther in, as well as increase debt costs, actually pretty significantly. All right, so as you know, there's 2 minority reports. This shows the rate commission did consider these items, and the majority voted against these issues. Debt service coverage of 1.6 is not a longstanding MSD policy. You're not going to find it written down anywhere in our policy. We work closely with our municipal advisor to target AA credit ratings. AA ratings is where the majority of rated sewer entities are, roughly 2/3. And so it gives us best balance of cost and access to market, especially given that we have a large consent decree. We still have 15 more years of extensive capital, billions of dollars of debt still left to issue. The phased-in approach on the extra strength surcharges, a strong 13-2 against. What that would do is shift some of the costs that are related to the industrial customers to consumers. So the rate commission recommendation here is protecting consumers by keeping those costs and charges with the industrial consumers. There's roughly 90 industrial consumers that have extra strength surcharges. The top 3 cover about 2/3 of the cost, roughly 65%. The largest one that would see a large increase is a large multinational corporation that had billions of dollars of after-tax profit last year. This rate would not go into effect until later next year. Generally, businesses have had no problem passing on inflation the last couple of years. I don't think they're going to have trouble covering this cost as well. I'm not going to talk too much more on this slide, but we're going to go over debt service coverage, how previous rate proposals were presented and the rate recommendations, the impact of those, and then kind of what we expect going forward if the board were to reject the rate commission recommendation. Next page, this is where MSD has been consistent. We've been consistent in our financing plan to target AA credit ratings. And with the help of our municipal advisor, we have determined that to be, and the rating agencies, 2.5 times senior debt coverage and 1.8 times all-in debt coverage. 1.6 was a recommendation from our municipal advisor back in 2015, but we have changed that to 1.8 as circumstances have dictated. And I'll walk through some of the rating agency reports and some of our metrics, and you'll see why that has changed. But 1.8 is not only what we have been using for a while, it is also what the rate recommendations have delivered as well, have been expected to deliver. All right, so the next page, we're going to look a little bit at the previous rate proposals and recommendations. So at the top part of this page, you see previous rate proposals, the 17 through 20 proposal and the 21 through 24 proposal. Those are our wastewater revenues and the expected coverage based on those revenues. The rate recommendation from the Rate Commission is in the middle there. You can see some modest changes to wastewater revenue. So they did reduce revenue in both cases, a total of about a little over $10 million for the rate cycle, 17 through 20, and about $16 million, 21 through 24. But the debt service coverage remained largely intact. It tweaked down a little bit, but maintained 2.5 senior debt service coverage and 1.8 combined debt service coverage. These aren't actual results. These were the results of the recommendations from the Rate Commission. So 1.6 has not been a long-standing policy of anybody. The Rate Commission, by the way, also does not set MSD policy. So these have been pretty modest decreases. I wasn't happy with them. Brian talked me off the ledge because the overall impact, expected impact, was relatively minimal. The next page, we look at the current proposal. We've got wastewater revenue at the top as well as expected debt service coverage. Those are roughly in line with where we've been previously, 1.8 all in. A little bit higher on the senior debt service coverage. That's because there's been a lot of federal stimulus over the last couple of years. We've gotten a lot more state revolving fund loans. That benefits our ratepayers. We've gotten some WIFIA loans. So we've increased the amount of subordinate debt we have. So that's why the 2.5 is not limiting, it's not a limiting factor anymore. But all in all, this combined debt service coverage of 1.8 is consistent with our past proposals and past rate recommendations. The proposed.
Tim, do you see any increases in as a percentage of our debt between the WIFIA and the state revolving fund?
Yes, we have lately. We have in the last few years. So we have issued more subordinated debt, which is the SRF, and in this large WIFIA agreement we just signed in the last couple of months, we also put it as subordinated debt because there's no additional interest cost for a lower rating. Usually subordinated debt's going to have a lower rating. So we have seen that mix shift. However, as the federal stimulus kind of disappears, we expect that to shift back to probably more capital markets debt in the future. And so that's what's modeled. And so the 2.5 times in the future becomes a limiting factor, not in this rate cycle, but by the next one, the expectation. So on the bottom here, you see the impact of adopting the minority report. The wastewater revenue recommendation impact is significantly higher than previous rate recommendations. We're talking $72 million. Previous ones were roughly 1% or less of overall revenue. Here, these last couple of years was over 4%. This is a significant reduction in our credit metrics and a significant increase in debt. Excuse me. And debt service costs last a long time. And it has to be covered, not like an operating cost. If you add $1 in operating cost, say inflation, you can cover that dollar for dollar in rates. These coverage levels we're talking about are essentially a multiple. So $1 of debt service cost has to be covered in revenue by 1.8 or 1.6 times. So even if you lower that multiple, the impact of increasing debt service is eventually still going to reach the same revenue need and then go over if you continue to issue debt. And when the 2.5 comes back into play, then you're talking at a 2.5 level, so it's even higher. That's why we expect future rates to be higher than under the alternative proposal that the Rate Commission rejected than our recommendation. On the next page, we'll talk a little bit about the alternatives that were reviewed. So the yellow line are the annual rate increases and the expected impact on a typical MSD customer. The rate proposals, those first 4 years, we like to show another 4 years. Again, those rates are not being put up for adoption at this time, but what we decide today does have an impact on what happens in the future. And so you can see where we expect rates to be based on our proposal. The rate commission's advisor or consultant proposed that middle line. They didn't propose it. They were asked by the rate commission to evaluate what it would look like if you went to 1.6. And so those are roughly 6% increases. They did not project out 4 years. But upon examination, when asked, they did express their expectation that rates would have to be higher in the future if you lowered them in this period. And our rate consultant, Reftelis, approached it similarly. They took bigger decreases in rates in this period, and then you can see the impact in the future. So you have rates going higher by the end of the next cycle, and then you should expect those to continue to go higher as the cost of continued additional debt is felt. So while I understand that everybody wants to do what's best for the consumer by keeping rates lower today, I think you are also doing a disservice if you're trading the short-term benefit for a longer-term cost. Again, those higher rates for longer is a real cost, and something that we and our consultant and the rate commission's consultant all expect from accepting these alternative proposals. All right, next time I want to look quickly at some of the rating agency metrics. So Moody's sewer medians for all-in debt service coverage has been rising over time. Roughly, these are low AA is their median. So it's a 1.9 coverage level, and it's gone up to 2.2. MSD's average over this time has been about 2.1. So we're roughly in line with the medians, even though we're at a high AA versus a low AA. The median for the AA category alone, though, is much higher. It's ranged from 2.2, gone up to 2.4, and roughly 2.3. Our average has been under that. The single A category is more in that 1.6 to 1.8 range. That's actually where we're targeting. So our targets are not overly conservative. As a matter of fact, I would say they are aggressive. Moody's publishes what it considers a single A versus double A kind of metric, and below 1.7 is considered a single A metric. So if we are going to target single A category ratings, we should expect to have eventually single A ratings, which would be an additional debt service cost. So our target is just sitting right above that cutoff. We've been able to exceed targets, again, with low inflation, with low interest rates, but that environment has changed. So that's Moody's. Next, we'll talk about Moody's operating revenue. The median is in the blue line, median solidly in the AA category. MSD's history is that black line. You can see us approaching the AA category here. Higher, more leverage is more debt. That is a lower credit quality. That dotted line is MSD's rate proposal that was accepted by the rate commission. That already puts us in single A category. That doesn't even count the impact of future decreases in our revenue and increases in debt, which would push this even higher up. But according to Moody's metrics, we're already in a single A category there. Again, MSD is not being overly aggressive in its ratings. Next, I'm going to talk a little bit about Fitch. So here you can kind of see the history of Fitch's reports, and this is why I have said in the past, why I said that we target 1.8 versus 1.5. I understand that our rate consultant in 2015 said 1.6 was a target, but that changed pretty quickly, and here's an idea of why that would be. So Fitch in the middle column, you can see kind of where they expect our metrics to be, and they're roughly in the 1.8, 1.9 range. By the end of 2018, they say they expect that it'll be over a 2. And then here's the comments from their reports. Initially, they say that if we have any deterioration in our financial performance beyond the projected levels, it could result in ratings action. By the next year, it says would be expected to result, and they kept that up. By 2018, even though they're projecting higher debt service coverage at 2 times, they say coverage margins that are weaker than forecast levels would result in negative rating action. So I bring this to you as physical evidence of what's going on, but also keep in mind that I am the one talking to the rating agencies regularly. I talk to them, I talk to the bond investors, as does our municipal advisor. So I'm bringing to you not just snippets from the reports they issue, but also information from the conversations we have. Whenever they issue ratings, we have a discussion about expectations. I shared with them the rate proposal. We had a discussion about, what we expect. So when Fitch published their affirmation of our ratings, they were doing that based on the rate proposal. I did tell them that we were having a discussion, that there was some pushback on some of those things, and obviously I'll have to let them know how that turns out. But on the next page, we can see kind of the metric of something that MIC had recently just talked about. So Fitch's leverage commentary from October 2023. She, I think, read some of this. Leverage is on a generally upward trajectory, peaking at 6.5. That is based on the proposal that was accepted by the Rate Commission. The alternate proposal, which would be lowering revenue and increasing debt, pushes our metric here over that 7 times that they target and says that is where that could lead to a negative rating action or a downgrade. And the expectation that this would decline in the future gets much more difficult once we cross that line, because we're looking, while the end of this rate cycle, we do see some lower capital expenses. It picks up again in the next rate cycle. So, in summary, the expectation should be that more debt, and this is a significant amount of debt. We're already issuing over $1 billion of debt in this next cycle. So it's not like we're trying, and we don't, like I said before, our only concern is to make sure we comply with the consent decree and that we are doing right by the consumer. There are different ways to look at that. We understand that the rate proposal we put before the Rate Commission has higher rates in the near term, but the expectation is that they will be lower for longer if we go with this approach. It's because higher annual debt service means higher user charge rates for a long time, because that debt lasts out there a long time. Those coverage levels will push financial metrics into lower credit category ratings. That's been told to us by the rating agencies. And it goes against the advice of me. I've been issuing debt for over 20 years and talking to rating agencies for over 20 years, and a municipal advisor who advises on a lot more debt deals than I'm involved in. The lower credit ratings add additional debt service. We haven't even modeled in the millions of dollars of additional debt service that would come from credit downgrade. So, but it would change these ratings. It would move these ratings even more solidly into lower rating categories. One of the things that we've relied on in delivering performance above what previous rate proposals have projected, like I said before, it's not been revenue increases. We've actually significantly under-collected revenue from projections. It is not coming from operating cost reductions. While there have been operating cost reductions from the projections, they've been more than offset by lower revenue. It's really come from lower inflation on the capital plan and some timing differences, as well as our ability to manage debt. We've been very aggressive with refundings. It's lowered debt service costs. And then we've pursued, where we can, lower cost debt. That's getting more difficult. Right now, interest rates are higher than what we have baked into the rate proposal. And we haven't even started the rate proposal period yet. So that is an additional risk factor that I think needs to be considered as well. But I think all these things taken together, MSD is not trying to screw the consumer. Again, we're not getting paid more for having more debt. Our financial advisor actually gets paid when we issue debt, and they're advising for AA ratings and less debt. So what I'm hoping to do today is to let you know that the Rate Commission recommendation, as they determined, is fair and reasonable. We should expect higher rates in the future and pressure or even lower credit ratings if the minority report is accepted. Any questions for me?
Ebony, thank you, Tim. Is the tech expert from the Consumer Council
Mr. Chairman, they do have 15 minutes left over from the original, so.
We're in good shape. Morning.
Good morning, almost afternoon. Appreciate the opportunity to speak to you today. Did have a PowerPoint presentation. I'm wondering if that's available. Thank you. I think that was it. Are we ready? Are you ready? Okay. Well, thank you very much. Again, my name is Mike Gorman. I've worked with the MIEC and MSD rate making matters for probably 20 years now. In each of those years, we've interacted with the MSD staff, the rate commission to make recommendations on what appropriate wastewater rates are and what appropriate financial policies are for setting rates. Those interactions have resulted, in my view, a consistent reduction in the proposed wastewater rate increases that the MSD staff has recommended over that time period. In this rate case proceeding, we unfortunately were not able to participate in the rate commission and offer the same sort of technical advice and recommendations to the rate commission because of the rule changes and our inability to get an intervention on file in time.
Excuse me, isn't John Stein from
Yes,
on the commission?
he is, yes.
And wasn't able to advocate?
Mr. Stein is not a technical rate setting expert. He's not a financial expert. He is able to participate in the rate commissions, but he was not in a position to offer expert opinions on the relevant issues, which go into measuring the MSD's revenue requirement and appropriate wastewater rates. That has been my participation along with Mr. Stein in the rate cases over approximately the last 20 years.
Okay, thanks.
Well, that is a background. In our intervention in wastewater rate cases, we've addressed what an appropriate revenue requirement is for the MSD to both manage rate affordability and to manage the financial integrity and credit standing of the MSD over that time period. And in each of those rate cases over the past, we've always been at odds with MSD staff's recommendations on the revenue requirement, largely because it has been based on profitability of the MSD, the overall debt coverages of the MSD that were more expensive than necessary to maintain the current bond rating of the MSD. MSD staffs in this case, as it has been in several of the last cases, was to set rates based on a debt service coverage ratio within the range of 1.8 times total debt and 2.5 times senior secured debt. In this case, that proposal results in approximately a 32.3% increase across the 4-year projected rate setting period. In previous cases, the rate commission has rejected MSD's staff's recommendation to increase that debt service coverage ratio range in setting rates. The rate commission approved, in the last case, a debt service coverage range of 1.6 times to 2.5 times. Very close to what the MSD staff has recommended, but yet less expensive. In this case, based on MSD's own projections, if that 1.6 to 2.5 debt service coverage range had been used instead of the 1.8 to 2.5 times, then the increased MSD's rates over the next 4 years would be about 24%, or approximately 20% less than what the MSD has proposed in this case and what the rate commission majority report recommendation made. The minority report, however, recommended continuing with the same financial metrics that have been used historically to set MSD's rate setting revenue requirement, which would result in about a 20% reduction in the increase in wastewater rates over the next 4 years. Could we go to the next slide, please? In evaluating the appropriate debt service coverage range, as Mr. Snoke just went through, there's an assessment of credit rating agencies and what they view as relevant in terms of maintaining the current bond rating, potentially having an adverse impact on the bond rating, or conversely, potentially having a positive impact on the bond rating. Currently, all 3 bond rating agencies rate S&P's bond rating as stable. That's an outlook for the bond rating. What does an outlook mean? That means credit rating agencies look at the outlook and they either rate stable, which means there's no imminent threat of a decrease or an increase in the current bond rating. A positive outlook would suggest that the bond rating is under review for possibly upgrades. A negative outlook would indicate that the bond rating is under review for a possible downgrade. The outlook for MSD's bond rating, very strong bond rating right now, is stable by all 3 credit rating agencies. What are relevant metrics and statements made by those credit rating agencies in support of those bond ratings? Well, Mr. Stoke went over some of them, but not all of them. All 3 credit rating agencies view very positively the rate setting process for the MSD. Historically, rates are set for a 4-year projected period, which is unusual for any water utility in Missouri and across the country. Most utilities set rates based on a single year of a projected cost of service. Why is that relevant? Because credit rating agencies view that as stabilizing the utility's ability to recover its cost of service and earn debt service coverage metrics in line with what they believe is necessary to maintain their bond rating. Customers pay higher rates to provide that rate affordability, that revenue stability to MSD. It's built into the rate-making process here. It's reviewed by all 3 major credit rating agencies as a credit rating positive for MSD. Same credit rating agencies did look at the debt service coverage earned by MSD. They also made comments about the rate setting process. MSD consistently earns a higher debt service coverage ratio than what has been used to project revenue requirements in the rate-making process. The rate-making process is that 1.6 to 2.5 times. There can be a little latitude in each of those metrics throughout the forecast because they're measuring slightly different things. But the forecasted revenue requirement is to estimate a cost of service within that range. And that's what was done in the last case, the case before that. And frankly, it's a little stronger coverages than the metrics that were used for cases that preceded those. MSD proposed 2 cases ago to increase that metric, as it has in this case, to a higher coverage, a debt service coverage. The rate commission rejected that in the last rate case. And as a result of that, credit rating agencies assessed the rate-making practices and the actual earned debt service coverage of MSD, and again, found that their bond rating is stable. That stability in their bond rating, that stable outlook, encapsulates the credit rating agency's full view of the credit standing of the MSD, not bits and pieces of the MSD, and it's what they report to the bond investing public, not in private conversations with Mr. Snow. It's what bond investors look at for the MSD in terms of whether or not they're going to buy your bonds. And from that standpoint, the rate-making process is a critical element of MSD's bond rating. It's been done in a positive, credit-supportive feature over the last several rate cases and has resulted in a stability and stable outlook for MSD's bond ratings. Can we go to the next slide, please? Mr. Snoke also made comments about whether or not changing the debt service coverage ratio to a higher minimum coverage would actually result in lower rates in the long term. That analysis was never offered in detail in the record, but I've summarized some of the filings that MSD staff's made in support of those contentions here. And what it shows is, I apologize, this is relatively small, and if I may stand up. In the first box is actually scenario 1, and that's the MSD's proposed rate making standards. The second box is, thank you. I apologize. Thank you. In the second box, and is it okay if I stand up here so I get closer to it also?
Fine.
Good. In the second box, we outlined the MSD's projections of the revenue requirement that would result if the rate making forecasted revenue requirement was reduced to a 1.6 to 2.5 debt service coverage. I offered this in terms of both the rate making forecast for this rate case, which is 25 through 28, the first 4 columns of both of those 2 boxes. And the second 4 columns deals with this notion of what's going to happen in the next rate case if MSD staff doesn't get everything they're asking for in this case. They argue that the rate increases will be even higher in the next go around if they don't get what they want. Well, let's look at their own forecast and see whether or not that's true. If you go down to the second area of projections made by the BPU, you see a line that says 5 CCF bill. That's a projection of the cost to our residential customers of wastewater sewer rates. And you see in the column for scenario 1, which again is MSD's forecast, is their projection that in 2029, under their proposed financial policy, the rate to a residential customer would be $78.86. Under the first year in scenario 3, which is the longstanding practice of the rate commission, to use a 1.6 minimum debt service coverage for total debt, the rate would be $75.51, lower. And you follow that line all the way across the forecast, and you see it's lower in every year up until the very last year of the forecast, fiscal year 2032. So let's look at fiscal year 2032 and see whether or not that projection for ultimately a higher rate is reasonable. The difference between these 2 scenarios is intended to reflect the difference in debt service coverage. Under the first scenario 1, it's a minimum of 1.8 with 2.5 on total debt. And the projected debt service coverage ratios, which are under the category performance metrics, the first 2 line, DSC senior and subordinate, the second line, it shows that under those projections, the debt service coverage ratios in 29 through 32 are all within that targeted range. Actually, the senior is a little bit higher. The minimum debt service total company is pretty close to the 1.8. But if you go out to 2032, in the second category of range, you see that the debt service coverage ratio for the total debt is 1.8 times, as a senior of 2.5 times. So that's higher than the 1.6 minimum debt service coverage. So then the next question is, for these numbers which have not been critically reviewed, were assumptions made that drove those numbers to be higher? And the answer to that is likely yes. Why do I say that? Is because all the projected additional bond issues in 2029 through 2023 are first mortgage bonds. They're not state revolving lines of credit bonds or loans. And that's a predominant feature of what the utility has been using, at least in part, to finance capital improvement programs. So I contest the accuracy of their finding that rates will eventually be higher in the long term if the Rate Commission's longstanding practice of setting a revenue requirement with a minimum debt service coverage of 1.6 times isn't continued to be followed in this case. Bottom line is that representation, I believe, is simply not accurate. Next slide, please. Another question on whether or not if we continue to add more debt to the MSD and we maintain debt service coverage ratios and a rate setting practice that has been embraced as credit supported by all the credit rating agencies.
Excuse me, we're running over the time period now. If you could either speed up or wrap up, we would
Okay.
certainly
Okay.
appreciate it.
Thank you. I appreciate that. This shows that over time, debt is paid off in addition to it being added to the MSD's cost structure. So the notion that debt will just continue to build up if you manage the level of debt and setting rates is not particularly true, because 20-year bonds would be paid off after 20 years, and this is a 40-year capital program. So many of the bonds that were issued 20 years ago are starting to be paid off. So you can add a little bit more debt and without increasing the total debt load of the MSD over time. You are increasing debt, that's true, but it's not a one-way street. Some is going away, other is being added, but to the extent you can set rates to recover that minimum debt service coverage ratios, that's appropriate. The next issue, next slide, please. What would happen that if we continue to give priority to rate affordability, in this case, an MSD did lose one notch of a bond rating? How would it compare to other Missouri utilities? Well, its bond rating right now is several notches higher than the bond rating of other Missouri utility companies. Other Missouri
Those other utilities are all private entities.
They are, but they also have to have cash flow stability to maintain bond ratings. They go to the same bond market to issue bonds, and the bond market looks at their credit rating and assessing whether or not they're a good investment for bond investors. So it is a reasonable comparison. It's not precise because they're different types of entities, but bond rating investors look at bond rating and assessing the investment risk of the enterprise and setting the price under which they would demand in order to buy the bonds. So it's relevant. Rate-making practices for investor-owned utilities, just like for MSD, have to be adequate to support a profit level that maintains rate affordability and that also maintains the financial integrity of the enterprise. And one more comment on rate affordability. If you want to maintain MSD's financial integrity, one critical element of it is to prioritize setting rates so customers can afford to pay their bills. If customers can't afford to pay their bills, the revenue receipts go in the toilet, the cash flow coverages of debt obligations are eroded, and the credit strength of the enterprise is eroded. MSD, while they claim they give priority to rate affordability in the past, the Rate Commission has disagreed with them then. I believe you should disagree with them once again in this
I'm gonna
case.
have to ask you to wind up, please.
My last comment is other utility companies in setting rates simply don't get everything that they're requesting. Last page of this goes to that effect. Often the biggest reduction in the revenue requirement request to the utility is a reduction to the profit level. And as a result of that, all utilities' bond ratings are stable. There's still strong investment grade credit ratings. MSD staff has never gotten everything they've asked for in a rate case before. The Rate Commission gave them everything they're asking for in this case. It's not necessary to maintain their bond rating, and it does not prioritize rate affordability. Thank you very much.
Thank you. Mr. President, do you have any closing comments?
No, I think I appreciate everybody for taking the time and providing a lot of information. Trustee Wilson, it's up to the board. If you want to go anywhere else or you're ready to adjourn, that's up to the board members as to how you'd like to proceed.
Is there anything?
You want to move for adjournment?
I'll make a motion.
Second.
So moved.
Okay. We thank you, all the participants, and meeting is adjourned.
Thank you. Thank you. Thank you.